5 key trends to watch in 2018 for pensions, the retirement market, as well as the capital markets. Now, we could certainly come up with more than that. We could come up with 5 key trends, but in the interest of time, we'll just focus on 5 of them. The 5 trends that we'll talk about today are tax reform, interest rates, PBGC premiums, the Department of Labor or DOL Fiduciary Rule, and exchange-traded funds or ETFs. The first key item is tax reform. And as you may recall, before tax reform was actually finalized in December, there were proposals initially to limit tax-deductible 401k contributions as a way of raising revenue. And that was also termed by some people as Rothification. But the final tax reform that was passed generally left the current retirement plan provisions untouched for now. And one potential positive could be the increased employer matches to 401k plans as a result of lower corporate tax rates. And we've begun seeing some of that. Now, despite the fact that tax reform has been left untouched for now, there are the impacts of tax reform that we want to look at both over the short term and longer term after this year, and see how it and try to gauge how it might impact the market and the economy. In the short term, we've seen a boost to corporate earnings from lower tax rates, and that's been one key driver of the record run-up in stock prices in 2017, and albeit there was some correction in 2018, there's still been record equity prices in 2018. And there is expected to provide a slight boost to gross domestic product growth in the U.S. of about 0.3% per year. Now, what about what we might consider the longer term, which would be after 2018? And one question is, will tax reform, how much will tax reform stimulate companies to create jobs and to increase their capital spending versus share buybacks and dividend increases? And what we've seen in the last 5 to 10 years, significant increases in share buybacks as companies have used their cash to support their stock prices. So we'll kind of have to see how that kind of trade-off plays back. Another important thing is the other side of the coin when it comes to the economy, which is consumer spending. And consumer spending represents about 70% of gross domestic product. So will these tax cuts and increased paychecks have any type of significant effect on consumer spending and people's income growing? Again, that's something we'll have to see, but that's might be considered sort of the other side of the coin from job creation and capital spending. Now, the last point under longer term is that widening future deficits. Now, if they widen, which already we're forecasting $1.5 trillion deficit, if they widen further, then because of congressional rules, then there'll have to be revenue raised or spending cuts or both. And that in turn may make retirement plans a ready target to raise revenue. So again, we'll have to see what happens to deficits, and that again may create a ripe target for retirement plans in order to come under the deficit limits. Second key item is interest rates. And before I talk about more about interest rates, just should note that the interest rates are determined in the bond market, and the bond market is incredibly large and complicated, and is almost 100 trillion in market value, and consists of corporates, governments, mortgages. There's a whole lot of different types of bonds. So rather than giving you fixed income 101 today, we'll just start with, or we'll just focus on the Treasury curve. And the Treasury curve, we need to distinguish between the short-term, intermediate, and long-term interest rates. And these all determine the shape of the yield curve. And the yield curve is defined as the various yields for the treasuries for various maturities. But the thing is that the shape of that curve is impacted by different things depending on short-term or long-term maturities. Short-term maturities, which is less than 1 year, are impacted by Federal Reserve actions, and the Fed has raised interest rates. They raised them in 2017, and we expect at least 2 rate increases in 2018. On the other hand, the intermediate and long-term part of the Treasury curve is affected by inflation, economic growth, federal deficits, and supply and demand in the bond markets for U.S. and non-U.S. investors. Just to give you a quick example of the last point, if the government is issuing a lot of debt to pay for programs or basically to fund deficits, then that's going to create a lot of bonds in the market, and that could end up actually pushing up interest rates. On the other hand, the non-U.S. investors, such as Europe and Japan, may be attracted by bond yields, by higher bond yields in the U.S. than in their own countries, and that could actually lower and help push down interest rates. But again, there's a lot of different interactions. Now, how does this come into, how it affects retirees and funded ratios? Well, just sort of very generally, and again, there are complex interactions here, but higher short-term rates should help retiree savers, especially ones that are conservative savers. But on the other hand, this may hurt financial institutions if the yield curve flattens. So what that means is short-term rates could go up, but if long-term rates either stay down or stay flat, then that narrows the gap between savings rates that banks have to give to customers and lending rates. So it could hurt banks, even though it could possibly help retiree savers. Now, in terms of funded ratios, lower long-term rates, again, if rates come down, it'll help bond prices, but may not help funded ratios very much if PPA rates also decline. And defined PPA is the 2006 Pension Protection Act, which sets guidelines for how liability should be discounted by ERISA plans. So if those rates decline, then liabilities could go up, and if equity markets don't sustain their rally, then funded ratios won't be helped very much and actually may lower. And now if we look at if long-term rates continue to rise, then that could help funded ratios, but again, it has to flow through to the PPA rates. Just as an aside, the PPA rates are actually based on corporate rates. But again, if they tie into the Treasury rates and the equity markets maintain their strength, then that would help funded ratios. Now, just to try to put a few charts to this, average one-year CD rates, there were several Fed increases in 2017, but you see there's been a very slow pass-through to CDs in this case. So you're probably going to continue to see these sort of very slow pass-throughs by financial institutions. Okay, the next is, okay, this Treasury yield curve we've been talking about. This is a snapshot of a curve from about a week ago. And as you can see, it's upward sloping. It's actually somewhat more upward sloping than it's been recently, as well as longer term rates have been rising. Okay, so you see that the longer, at the bottom it says tenor, that's really basically the same as maturity. So the longer maturities have higher yields, but again it's more striking, I'd say, from 1 month to 10 years than otherwise, but still upward sloping. And what does that mean? Again, that could be good for banks as well as could be good for funded ratios, but again, that also depends upon how this will impact the stock market and the bond market as well. Whoops, sorry about that. Okay, the last chart says TIPS break even. TIPS are one of our options in our 401k plans, defined contribution plans. And TIPS is Treasury inflation protected securities, and it provides a market forecast of inflation. So inflation, it's not only how it's measured every month by the Bureau of Labor Statistics, but also the TIPS will give some indication. Well, what is this saying? This is saying that pretty much recently the inflation has hovered around the 2% level. The Fed seems in general to have a more aggressive outlook on inflation, which is a reason why the market, or some people expect there to be as many as 3 or maybe 4 increases in 2018, but certainly at least 2. Okay, third, PBGC premiums. They've been going up, as we all know. Flat rate will go from 69 to 74 per participant in 2018. The variable rate premiums will increase from 34 to 38 per thousand of underfunding. Why are the premiums increasing? Well, two reasons. Collectively bargained plans are projected to be insolvent within 8 years. So rather than waiting for those plans to basically become insolvent and have a huge bill in terms of bailing them out, premiums are increasing now, hopefully to build up some sort of reserve. Second point, the premiums are indexed to inflation. Strategies to mitigate PBGC premium increases. Again, the idea here is to reduce headcount and or funding deficits for purposes of these premiums. And these are items which a lot of pension plans have either looked at or are doing, including PENTagra's. And those strategies include lump sums, early retirement incentives, partial or full freezing of plans, annuitization with third parties such as insurance companies. Okay, so as a way to get the liabilities off the books, so to speak, and advance funding to increase assets. In December of 2017, there were over 100 million in contributions to the multi-employer defined benefit plan, and part of that would be considered kind of an advanced funding type of strategy, again to reduce the deficits for the PBGC premiums. Number 4, DOL, Department of Labor Fiduciary Rule. The bottom line here is that the rule is here, basically. I mean, it's here. Even though the final implementation date is scheduled for July 2019, the key components of the DOL Fiduciary Rule are in place. And you could look at these as kind of pillars to the rule. I mean, it's a complex rule, but the pillars would be fiduciary advice, the definition of a recommendation, and best interest standard. Now, the DOL Fiduciary Rule expands the definition of a fiduciary to broker-dealers, RIAs, registered investment advisors, and importantly, for the retail market especially, IRA transactions and rollovers. Okay, according to the DOL, fiduciaries include persons who make recommendations for a fee or other compensation. And I won't read the whole definition, but at the end, again, it includes rollovers, and IRAs are in the definition. Okay, so that's the fiduciary definition. A recommendation, which would put a provider, an advisor under the rule. A recommendation is a suggestion for a given course of action. Now, not everything is considered a recommendation. There are some that are exempt from this rule, and that includes investment education, platform providers, general communications such as research, newsletters, and prospectuses. Okay. Now, one issue that comes up, or one question is, well, with this fiduciary rule, is this going to be the end of commissions and variable fees, and fee waterfalls and that type of thing? Is that going to be kind of the end of it, or can we not have commissions or variable fees? Well, the answer is you can still have commissions and variable fees, but there's a much higher bar to being able to comply with the rule. An advisor has to provide non-discretionary advice and adhere to the DOL's best interest standard, which involves prudence and loyalty. So again, while it's not ruling out these commissions, variable fees, there's a much higher bar than before. Action items for plan sponsors. Some of the key ones include review procedures and communications, review fiduciary liability insurance coverage, review vendor compensation and contracts. So there is an element of disclosing compensation structures as well as conflicts of interest or potential conflicts. Review investment guidelines and policy statements. I mean, that's something that our plan, Pentegra's plan, has, which a lot of ERISA plans have. But again, it's important to review those guidelines in light of the rule. And in terms of non-ERISA plans like public plans, there is more extensive disclosure. And that's really partly because of there probably aren't the amount of detail and policy statements as there are with ERISA plans, but nevertheless, there's more disclosure required for these type of plans. Okay, fifth, final, exchange-traded funds, ETFs. ETFs have exhibited a lot of growth, tremendous growth in the marketplace, along with growing popularity among advisors. ETFs, while they remain a relatively small fraction of total passive index funds plus actively managed funds, I'm going to say I think somewhere between 5 and 10%. There's been an explosion in the number of ETFs. So there were twice as many ETFs at the end of 2016 as there were in 2009. And according to the 2017 Investment Company Fact Book, there's a total of about $2.5 trillion in assets. ETFs, some of the appeal of ETFs involve real-time pricing and real-time buys and sells. ETFs, a lot of them are sector-focused, such as a technology ETF or healthcare ETF, versus a broad market like the S&P 500 index funds. The ETF expense ratios are generally somewhere between index funds and actively managed funds in the 15 to 20 basis point area. The last point is, despite all these ETFs coming on board, generally only the largest and oldest ETFs thrive and survive. Okay, so that basically means that the biggest ones have the track record and to some extent the ability to price more competitively. And the last chart here, next page, shows that point. In the gray, if you look at the gray line at the bottom, the share of the top 5 providers above are nearly 90%, and there's been significant growth year to year in assets, certainly over the 2016-2017, and that trend has been continuing. Okay, with that, I'd like to thank everybody for calling in today, and have a very nice morning and afternoon. Thank you again.
Fred, before we leave,
Yeah.
we do have one question. See if you can answer this question. We have a few more minutes. Please address the rising interest rates hurting bond holdings within target date funds, causing them to underperform.
Okay. Well, target date funds, particularly the ones, that's a good question, particularly in the longer maturity, in the more conservative strategies, have a fairly significant percentage in bonds, both long-term and intermediate term. What's happened, I think, is that the kick up in interest rates has pretty much hit all parts of the bond market. Intermediate bonds maybe to a lesser extent, but certainly in longer term bonds, and that's certainly that's hurt the bond return somewhat, and that's offset the gains that we've seen in the stock market. Now over time, that could reverse. I mean, you could actually see interest rates eventually coming down again. But there's no doubt that that's the rise in interest rates is pretty much hit the hit investments pretty much across the board. But again, I'd say less so in sort of the might be considered the Bloomberg aggregate, more the aggregate bonds, less so than the long-term bonds.
Okay, thanks. That was the only question that we had pop up. So if you have any questions, again, you can reach out to us on the screen right now. We have our email address, and you'll be able to have our email addresses on the follow-up tomorrow that comes out with the re-recording. You'll have contact information for Fred and myself should you want to reach out. So again, thank you for coming today, and Fred, thank you for your time. We appreciate it.
Thank you.
Have a great day. Bye-bye.